Welcome to this explainer. Today, we are looking at an absolute masterclass in corporate evolution. If you've been watching the luxury market lately, you know the era of explosive, unquestioned growth, well, it's hit a speed bump. Consumer habits are shifting, global economics are, to put it mildly, volatile, and even the absolute titans of the industry are having to rethink their entire playbooks. So today, we're going to unpack the 2026 strategic recalibration of the undisputed king of luxury, LVMH. We'll explore exactly how they are shifting from rapid expansion to a highly focused, calculated pivot in an uncertain world. To make sense of this massive shift, we're going to hit 5 key areas today. First, a luxury giant recalibrates. Second, financial resilience in numbers. Third, trimming the empire. Fourth, the next generation. And finally, the future of luxury. Let's get right into it. Okay, part 1, a luxury giant recalibrates, navigating a changing world. To really understand LVMH in 2026, we have to look at the tension between the sheer monumental scale of Bernard Arnault's empire and the geopolitical headwinds they are facing right now. Think about it like this. It's one thing to steer a speedboat through choppy waters. It is entirely another to steer a supercarrier. And man, what a supercarrier this is. We're talking about the world's largest luxury goods conglomerate, headquartered right on Avenue Montaigne in Paris, managing a portfolio of over 75 prestigious brands. They've got fashion powerhouses like Louis Vuitton and Dior, elite jewelry with Tiffany and Company, high-end beverages like Moet and Chandon, you name it. The central takeaway here is that when you are at the helm of an empire this fast, a strategy of simply growing everywhere all at once eventually hits a ceiling. Even a giant of this size absolutely must constantly evolve its strategy to survive shifting consumer demands and global instability. Moving on to part 2, financial resilience in numbers, the true growth story. So, how is this evolution actually playing out on the balance sheet? Well, let's look at the big number that caught everyone's attention on July 27th. For the first half of 2026, LVMH reported revenue of 38.6 billion euros. On a reported basis, this represents a 3% dip compared to the exact same period last year. Now, for a company that is so used to endless upward trajectories, a 3% decline sounds like a massive alarm bell, right? But as we know, in corporate finance, reported revenue doesn't always tell the whole story. This initial decline was actually largely driven by heavy currency headwinds, specifically an incredibly strong euro that really impacted their global sales conversion. Now, what's really interesting here is the organic growth. When you strip out those currency fluctuations and one-off effects, organic revenue actually grew by 2% year over year. Underneath the surface, that core business engine is absolutely still expanding. And it gets better. That organic growth actually accelerated, hitting 3% in the second quarter. In fact, if you exclude the dampening impact of the conflict in the Middle East, that Q2 figure jumps to a very healthy 4%. So the crucial point here is that operational demand remains strong, even when macroeconomics are trying to drag the numbers down. Let's break down how this growth builds across their specific divisions, because it's pretty revealing. The absolute standout performer? Watches and jewelry. They generated an incredible 9% organic growth for the half, which actually hit 11% in Q2 alone. This is largely being driven by the massive success of iconic lines from Tiffany and Bulgari. Right behind them, we see selective retailing, which includes powerhouses like Sephora, posting a solid 5% growth as they continue this aggressive global expansion. Even wines and spirits, a division that sometimes fluctuates quite a bit, saw a very healthy recovery with 5% organic revenue growth. But of course, we have to talk about the crown jewel, right? The fashion and leather goods division. This is the home of Louis Vuitton and Dior. They brought in 18.14 billion euros. And while this division did see a reported decline in the first quarter, what you really need to take away from this is the rebound. They completely reversed that trend, returning to 1% organic growth in the second quarter. It's a real testament to the fact that when LVMH leans into its core, it can course correct almost in real time. And we don't have to guess how they achieved that rebound either. Bernard Arnault himself connected the financial numbers directly to their creative wins. He noted that this accelerating growth arose in particular from the success of Jonathan Anderson's very first designs for Christian Dior. He also specifically pointed out the remarkable performance of exceptional, highly experiential new Louis Vuitton stores in key Asian markets, specifically Beijing and Seoul. It just brilliantly illustrates how targeted creative choices and physical retail investments are literally driving billion-dollar turnarounds. Which brings us to part 3, trimming the empire, the art of the sell-off. Now we get to the so what of their corporate strategy. While the core is growing, what are they doing with the rest of the portfolio? Well, in 2026, LVMH is making the conscious, deliberate choice to prioritize deep profitability over sheer, sprawling portfolio size by offloading their non-core brands. And they are not making small moves here. In May of 2026, LVMH agreed to sell the Marc Jacobs fashion brand in a deal valued at a staggering $850 million. The buyers were a joint venture between brand management firm WHP Global and the apparel company G3 Apparel Group. This is a massive moment. It ends nearly 3 decades of LVMH ownership, going all the way back to 1997, but notably founder Marc Jacobs will remain as the brand's creative director. So LVMH cashes out, but the brand maintains its creative continuity. To really understand why they did this, let's look at an insight from supply chain consultant Britton Ladd. He says, this underscores a new playbook of owning the IP, licensing aggressively, and keeping operations lean. This is exactly what you need to take away from this move. LVMH is simply no longer interested in holding on to brands that require heavy operational lifting without delivering Tier 1 margins. They are pivoting toward incredibly lean operations and hyper-focusing their capital. And if you want a perfect case study of this disciplined, almost ruthless new strategy, just consider the trajectory of Patou. LVMH acquired the dormant label back in 2018, attempting a grand revival. But watch what happens next. The CEO departs in late 2024. Then the artistic director leaves in early 2026. Rather than pouring more money into a sinking ship, LVMH just cuts their losses. By August 2026, they sell it right back to its original owner, Dubai-based entrepreneur Dileesh Mehta. It is a masterclass in disciplined choice. If a brand isn't serving the larger profitable empire, it is swiftly removed. No hesitation. All right, part 4, the next generation, a leadership shakeup. Because an empire isn't just brands, right? It's people. Alongside trimming the portfolio, Bernard Arnault is fundamentally reshaping the human leadership of LVMH's 2 absolute biggest moneymakers ahead of February 2026. And this strategic swap at the very top is fascinating. On one side, we have Delphine Arnault, Bernard's daughter, stepping up as the new head of Christian Dior Couture. Arnault praised her sharp eye and incomparable experience. She takes the reins from Pietro Beccari, who is moving over to become the new head of Louis Vuitton, which, by the way, is the world's leading luxury brand by sales. Arnault highlighted Beccari's exceptional work at Dior over the past 5 years. It's a brilliant strategic cross-pollination of their absolute best talent across their best brands. But there's a deeper family dynamic at play here too. Portfolio manager Arnaud Cadard calls these moves clear signs of trust and a desire to keep a balance between outside people and Arnault family members. And this is vital context for us. Currently, all 5 of Bernard Arnault's children hold top jobs across the LVMH group. By elevating Delphine to Dior, while at the same time placing a proven outside expert like Beccari at the helm of Louis Vuitton, LVMH is perfectly balancing internal family legacy with external tested expertise. Finally, let's wrap up with part 5, the future of luxury, looking ahead. So let's tie all of these threads together. We've seen the financials, the sell-offs, and the executive swaps. What does this actually mean for the future of LVMH and, by extension, the future of the luxury market as a whole? Simply put, they are doubling down on what works. LVMH's forward-looking strategy is neatly packaged into 4 main pillars. First, enhance brand desirability, keeping that high-end dream factor alive. Second, invest in retail excellence, which we saw with those highly successful new physical stores in Beijing and Seoul. Third, celebrate heritage and craftsmanship. And fourth, maintain strict financial discipline. By combining the magic of luxury with the math of lean operations, they are currently maintaining an incredibly high operating margin of 22.5%. They are protecting their profits fiercely. And if you want to see how they actively build that dream factor and celebrate craftsmanship, just look at this number, 65. That is the number of venues LVMH is opening across 11 different countries for their Les Journées Particulières 2026 program. They are literally opening their doors to let the public see the invaluable artisanal expertise of their craftspeople up close. It's a brilliant marketing move that completely leverages their deep historical heritage to justify their premium positioning in the market. So, as we wrap up this explainer, I want to leave you with a lingering question. We've seen LVMH sell off Marc Jacobs and Patou, streamline their focus, and elevate a mixed leadership team of family and external titans. Looking ahead, is trimming the fat the new mandatory survival strategy for all luxury brands in the next decade? I mean, if the biggest player in the room feels the need to get leaner, what does that mean for everyone else? It's definitely something to keep a close eye on. Thank you so much for joining me for this deep dive into LVMH's art of reinvention. Keep questioning, keep learning, and I'll see you in the next explainer.